Hello everyone, Marco Lima here with the market report for March and April. March was a challenging month for investors as markets were driven by a combination of geopolitical shocks, inflation concerns, and a reset in growth expectations. The S&P 500 finished March down approximately 5.1%, while the Nasdaq lost about 4.8%. Technology and growth stocks remained under pressure as investors rotated away from high valuation names and towards energy, defense, and more inflation-sensitive sectors. The biggest driver was the escalation in the Middle East following the Iran conflict and began at the end of February. The market's concerns center on potential disruptions through the Strait of Hormuz, which pushed oil prices sharply higher. Higher energy costs immediately revived inflation fears and reduce expectations for near-term Federal Reserve rate cuts. On the bond side, the Bloomberg U.S. Aggregate Bond Market Index was relatively resilient, with high-quality bonds providing stability as investors moved towards safety. Falling Treasury yields late in the month helped support core bond returns, especially after softer labor data and weaker job openings, which suggested that the economic momentum may be cooling. From an economic standpoint, investors were balancing two competing narratives. First, persistent inflation risks from higher oil prices, and second, signs of a slowing economical activity. That mix created volatility across both stocks and bonds while keeping recession discussions active heading into the second quarter. As we move into April, there are both opportunities and concerns. Of course, the opportunity is that much of the March decline was driven by fear and headline risks rather than major deterioration in corporate earnings. If political tensions that de-escalate and oil prices stabilize, we could see a relief rally, partially and particularly really in oversold technology and high quality growth names. Bonds may also continue to benefit. Inflation pressure continues to ease or begin to ease, and the market started to price in a more supportive Fed later this year. The concern here is that prolonged geopolitical conflict or sustained oil above recent highs could keep inflation sticky, pressure consumer sentiment, and delay rate cuts further. That would likely keep volatility elevated and make sectors in selection and risk managing especially important. For long-term investors, April may present selective opportunities to rebalance into quality assets at a better valuation while maintaining appropriate diversification. We hope that this conflict would end soon, which will come back to normal investment management. Thank you for listening in, and for additional information, visit MRA Advisory Group.